This is SFNet Presents In the Know, sponsored by Hilco Global.
Hello, and welcome to the latest episode of SFNet Presents In the Know. I'm your host, Barry Bobrow, Managing Director and Head of Credit Markets for Regions Business Capital. Through the In the Know video and audio podcasts, I'll be bringing you a series of conversations with thought leaders on important topics impacting the secured lending and asset-based lending markets. Joining me today for what we hope will be a timely and highly insightful discussion of second quarter debt markets are my good friends Maria Dikeos and CJ Doherty of Refinitiv, an LSEG company. Before we begin, though, I want to make an important disclaimer. Any views or opinions expressed in today's discussion are statements of the speaker's opinions, are intended for information purposes only, and are not formal opinions of or binding on Regions Bank, its parent company, Regions Financial, and any of their subsidiaries, and any representation to the contrary is expressly disclaimed. The same goes for my guest today from Refinitiv. Thank you all in advance for watching and listening. I welcome your feedback on today's discussion, as well as your suggestions for future topics and speakers. Let's bring on Maria and CJ. Maria and CJ, good to see you guys. And before we get going, for those who don't remember everything about you, why don't you just talk a little bit about what you do at Refinitiv?
So I head up global loans contributions at Refinitiv LSEG, focusing on data collection as well as analysis across the loan market.
And you're the world's expert on the asset-based market too. Don't forget that part.
Oh, okay. Thank you.
And I'm CJ Doherty. I'm Director of Analysis here at LPC, covering the leveraged loans, CLO, and private debt markets, including BDCs.
Great. Well, great to have you guys here today. I think we're going to start. We've got slides, and for those of you who are not watching this but are listening instead, I strongly encourage you to download the slides, which will be available on the SFNet website, and we'll try to talk through them as we go. Why don't we start, Maria, with you and CJ? I think you're driving here, so why don't we go to slide 2, the next one? Great. Maria, why don't we just talk about, this is high level U.S., this is the broadly syndicated market, but leveraged loan and bond issuance, it's not a great story this year, not a happy story anyway, but it's an important one. Why don't you talk a little bit about what's going on in second quarter and first half?
Sure. So I think the best place to start is by noting that overall market tone in the second quarter was healthier or generally a little bit better than either the year ago period or in the first quarter. And that's generally the good news. The less favorable news is that the results that we saw in terms of numbers are not as robust as the market would have hoped. And we'll certainly talk about the reasons for that. At a high level, lending across the broadly syndicated loan market was off in the second quarter compared to the year ago period. Syndicated loan volume was down 32% at $571 billion. New loan assets were the lowest they have been since the height of the COVID pandemic. And the leveraged loan market was down nearly 36% in the second quarter. And issuance for the first 6 months of the year was down over 25%. So, I think that all of this is really noteworthy because the market in general felt a little bit more stable in the second quarter than it had after the turbulence in late March or early April when we saw the failure of the sale of Silicon Valley Bank and Republic Bank, et cetera. So I think in general, the market felt a little bit more reliable. We saw that in the leveraged space. We saw loan bids kind of edge up from 94.5 to well over 95.6 in the secondary. And we also saw that come in combination with just a more resilient bond market. So that was kind of the positive. CJ, if you could go up one slide. So We also saw yields shoot up dramatically to the highest level that we've seen since the 2008 credit
This is a great
crisis.
chart, and for those of you who can't see it, just a huge run up. Over a 10-year period, you're at the highest yield, not the spread, but the yield
Right.
on single B and double B credits, and you can see it exactly when the Fed started going to work on inflation. The 5% plus run up in the underlying has driven yields up. I encourage everybody to download the chart.
Right, right. And I think that you're exactly right. I mean, it's really on the back of the Fed action, and that supported SOFR levels kind of going up to about 5%. So it just, from the lender perspective, it all looked better. But if we advance one slide, CJ, thank you. We see that nevertheless, kind of liquidity became more precious. And so that kind of tempered overall appetite in the market, and certainly momentum in the market. Despite the rising interest rate environment, outflows remained a concern. And as of the end of June, we had nearly $52 billion exit the loan market in the last 12 months. At the same time, as you'll see in the chart on the right, what we show is that CLO liquidity slowed during the quarter, with issuance falling 37% to just over $21 billion. And I'm sure we'll talk about this a little bit more, but fundamentally, the challenging arbitrage made it tougher to get new CLOs out the door. So that kind of tempered liquidity and created some uncertainty in the market in general.
Yeah, and the chart also shows that AAA spreads are really near the high point
Yeah.
on the chart, which makes that arbitrage even tougher for new CLOs that are being created.
Right, right. So I guess what we want to talk about next, Barry, is probably what did get done.
Okay.
And that, I think it's really refinancing activity. It dominated the pipelines. We saw borrowers and lenders really remediating for SOFR adoption. Occasionally, that came in combination with pushing out maturities during the same sort of process, or making some modest changes to existing terms. But quite often they came just with a prioritization of SOFR adoption.
Is it safe to say, Maria, that with pricing elevated, with yields, all-in pricing higher, that issuers are largely staying on the sidelines if they don't have to do something to avoid the repricing
I definitely
event?
think so. Yep, absolutely. And I think that what this chart in particular shows is that, we know that there has been more in the way of refinancings, but you see that the maturity of institutional term loans or institutional loan issuance really is still concentrated in the 2026 to 2028 period. So there's still room to kind of come back to the market and refinance with an eye towards pushing out the maturity wall.
Mm-hmm. Yeah, I mean, it makes sense. If there was a really robust period of issuance at attractive prices in 21 and 22, early 22, and those are 7-year maturities. That's what you're looking at, is that maturity wall. And but it does seem like, and I guess I'll pose this as a question to you guys, but it seems like we should start to see people chipping away at that if they haven't already, to push beyond it certainly in 24 and 25.
Yeah, I think that makes sense. I think that there's a bit of an effort or to time the market and hopefully kind of, see better conditions for the borrowers.
Yeah.
Yep.
Good deal. CJ, next one.
Yeah, please. So, in contrast to the refinancings, what we saw in the M&A space is that certainly chatter picked up during the second quarter, but it was still very, very tough. Leveraged M&A deal flow was down 76% year over year during the quarter, and there was less than $5 billion of LBO activity completed in the second quarter, bringing totals for the first half of 2023 to less than $10 billion, and that's down 86% year over year. And as we noted earlier, and CJ and I were chatting about it before this podcast, the higher yields were more advantageous or more interesting for lenders, but it made it much harder for borrowers to, far more expensive for borrowers to tap the market. So that was one aspect. And then at the same time, lenders were just a lot more credit conscious about when it came to looking down market for new lending opportunities or transformative deals. So, it was a combination of those factors that sort of dampened any potential momentum.
Yep. Definitely a tough time for the M&A. And you had some interesting data here. You've got the slide, and then you also talk about your survey data. So why don't you tell us about that?
So this survey data, this slide sort of indicates some market sentiment based on respondents to our survey. And it was basically, we posed the question, what are your expectations for leveraged M&A loan volume in the second half of the year? And then what are your expectations for LBO financings in the third quarter? And I think that the key takeaway here is that, nobody expects huge momentum. There's sort of an percolating opportunities, but nobody expects huge momentum. Green shoots, we put that in there because there's a bit of chatter, but the lead up time is very long, and it's just, via the broadly syndicated loan market in particular, it's not always successful. That's sort of the key takeaway.
Yep.
And in the next slide, what I think many folks in the audience know is we run a quarterly buy side and sell side survey. These are sort of the key takeaways that we got from our respondents, and they sort of summarize what we show in terms of numbers in the prior slides, and I think there's the three key themes from the quarter are what were laid out by this one lender who just focused on what we touched on, which is that M&A seems to be picking up, but it's very early and it's tenuous. The market is less volatile right now than it was in the year ago period, but there's that sense of less liquidity. So it doesn't mean that there will be any strong pickup anytime soon. And everyone is really looking at CLO health and what that means in terms of longer term liquidity.
Got it. Thanks, Maria. Well, the flip side of the tougher conditions and the slower conditions in the broadly syndicated market is that the direct lenders continue to have their growth period, their day in the sun. CJ covers the market extensively, so we wanted to make sure we really covered it here in this discussion. So CJ, why don't you take it away? Talk a little bit about what you see in direct lending, and I'll preface that by saying, it's not an observable market in total from a data standpoint. There's certainly a lot of reporting on it. And so what CJ lays out is a number of components and showing how they're growing that are observable, but there's certainly a big sort of unobservable market that's more anecdotal.
Yeah, thanks, Barry. So just to kick off here, the private credit or direct lending market has grown, grown further this year. The chart we're showing here looks at BDC assets under management specifically, and BDCs are the most visible part of the market. The data here is just through the first quarter, as second quarter earnings season has just started. But what we see here is that the BDC market size is now at 280 billion, and it's grown dramatically in recent years. And even just if we looked at first quarter this year, it was a smaller growth, I guess, just over 2%, but year over year, it's grown over 20%. So definite upward trend there. Private non-traded BDCs like perpetual life BDCs have been the driver in recent times, with retail money flowing into the market, especially in the last year and a half. And then if we just move on here, the next chart that I've put up looks at fundraising. And despite the growth I've just discussed, fundraising is harder more recently for direct lending funds from what we're hearing from lenders. And indeed, the data we're showing here really bears that out. Just below 10 billion of middle market private debt fundraising was tracked in the second quarter, and that was the lowest quarter since third quarter of 2016. That said, it does follow on from a strong first quarter. I think here that many investors have really boosted their exposure in recent times, so that the surge has lessened more recently. And also, obviously, there's some degree of economic uncertainty has prompted a wait and see approach for some. But it wouldn't surprise us if it was basically to kick off again.
Yeah, I mean, if you sort of average the last couple of quarters, it's lower than in the past, but it maybe this first quarter pulled forward some of the fundraising from that would have gone on in Q2.
Exactly, that's definitely a possibility. Just want to move on now then and talk a little bit about direct lending activity. And as Barry mentioned at the start, there is a lot of it's not the most transparent market. Like I mentioned, I showed some BDC data there, but now I'm going to move on to some of the private data that we collect as an institution across a wide variety of lenders to kind of try and provide some transparency and some insight into the market. And here we're looking at middle market sponsored lending activity. And basically here we see that the third quarter turned out to be a tale of two markets between direct lending and the syndicated sponsored segments. The chart here basically shows that syndicated lending really weighed down the total volume as issuance dropped 26% quarter over quarter. In contrast, direct lending was up 32% in the second quarter. Having said that, if you were to look at both segments year over year, they're both down. The syndicated market off by more than 65%. Direct lending was also lower at 46%. So definite pickup in the most recent quarter, but not quite the highs that we've seen previously. And from talking to some lenders here, they say that deal quality has improved in the last quarter as they were, really more selective in more recent times and in the most recent quarter. And so it was.
CJ, excuse me, that seems hand in hand with the challenging fundraising environment, and so with what limited capacity the fund managers have, they're certainly being more selective, and probably, and I guess a question for you, I hear smaller ticket sizes as well, given diminished capacity.
Yeah, definitely. We have seen smaller ticket sizes. We've actually probably seen that over the last year. So it's kind of a continuation of a trend that kind of first came into being when the economic outlook got a lot softer and the Fed started raising interest rates and inflation took off. So it's definitely, I think, just a way, lenders are being more selective. They're being a bit more cautious. And a way to do that is just to take smaller ticket sizes.
Mm-hmm.
And also, just tying all that in, the market is a lot more bifurcated now than it was, and the higher quality deals are being particularly sought after. That's a theme that lenders have set across the board, which is interesting. And so basically overall, I would say, liquidity continues to be available for borrowers, but lenders and especially, I guess, even banks as well, they're definitely more risk sensitive, backing off from some of the volatile sectors and taking a more measured look on the use of their capital.
Mm-hmm.
The next slide I'm putting up here basically relates to what I just described, and it looks at direct lending versus syndicated lending, and looks at them as a ratio. And basically, we see that the ratio of direct lending to syndicated lending climbed to 2.6 times in the second quarter. So a definite trend there, and that basically what it really illustrates is the extent to which direct lending is outpacing the syndicated market these days.
Yeah, it's an interesting, just to sort of recap it, the total volumes are down, but they're down a lot more sharply in the broadly syndicated market than in the direct lending. And so you see the growth as a percentage is increasing for the direct lenders. Is that what we're looking at?
Yeah, in this particular one, yeah, it's basically the syndicated market is down in the most recent quarter. Direct lending has actually managed to increase, which is so that's why they're gaining here. In a couple of charts, I'm going to show a very similar slide, and that will basically show that it'll be focused on LBO activity, and that will show that syndicated is down more than direct lending. In other words, both are down. It's just syndicated is down even more. So we'll save that one for to show you that shortly. Next here, just wanted to focus specifically on LBO issuance, and what the charts here show is that LBO issuance continued in its downward trend, and that's whether we're talking about direct lending here or syndicated LBO issuance. And again, this is all middle market activity we're talking about here. So basically, to put some numbers on it, middle market LBO volume dropped to $6 billion in the second quarter. Having said that, syndicated LBOs were hit the hardest. They collapsed actually close to 75% to less than 500 million, and direct lending was down about 12% to $5.5 billion. So despite this, so we've definitely seen a downward trend. I from speaking to some lenders, there are some which are optimistic that things are going to pick up. There seems to be a little bit more coming together between buyers and sellers on price, and also arguably some improvement in the economic backdrop. So we'll have to kind of basically monitor that going forward. In terms of deal activity as well, we've also heard that more minority deals, more minority deals where sponsors don't want to sell the whole company, but they want to take some chips off the table. So seeing some of that. And then outside of LBOs, add-on activities have once again been active, lenders supporting their existing portfolio companies through add-ons. And then if we just move on now to the next chart, and this kind of rehashes what we just were discussing a minute ago, where we're again looking at LBO activity and comparing the ratio of direct lending to syndicated LBO issuance. And here we see that LBOs financed in the direct lending market was really eye-opening 11.5 times higher than the volume of syndicated LBOs in the most recent quarter. So it's basically, to what I said earlier, it's unlike the chart I showed a couple of slides ago. Here, the jump in direct lending shares is due to direct lending falling less than syndicated.
Yeah, it's a really stunning. It's a stunning chart, and I think the underlying causes make sense. You have a diminished level of M&A, but also a diminished level of bank appetite for that kind of risk. And so, in seeking the financing for the available deals, it just looks like the private equity sponsors are really trending much more towards the certainty of direct lending. That's certainly the case that's being made by all the people who are involved in the direct lending space.
Yeah, absolutely. Certainty of execution is one of the main selling points for direct lending. So they're really, some of the data is really backing that up. Now I just want to take a closer look at unitranches. And here what we see is that there was a 45% drop in large corporate unitranche lending. In the middle market, again, a little bit of a different story. Unitranche volume also fell, but fell by a much smaller amount. It fell to about 4 billion from 4.7 billion in the second quarter. So the overall impact of that was that total unitranche volume fell to 9.5 billion, roughly its lowest level since the second quarter of 2020. And indeed, the average unitranche size tumbled to 169 million. And that was the lowest since the first quarter of 2019. And that was due to less, jumbo unitranches backing large LBOs.
Yep.
And just to provide a little bit more context here as well, when it comes to kind of the jumbo unitranches, in the second quarter, there was only one unitranche deal that exceeded 1 billion. And there was no deals which made it into our list of the top 40 biggest ones. So, just the larger deals not as prevalent in the most recent quarter. Now, just to move on and look at some credit metrics, what we saw in the most recent quarter in the direct lending market was that leverage ticked up. From what we're hearing and what we're seeing, it's a very bifurcated market now. It's the stronger credits that are able to push their leverage higher. So when we talk to lenders, they say that it's not underperformance that's driving the increase in leverage, but rather it's a reflection of newer portfolio companies that lenders feel really good about, that have this higher leverage profile. And the chart we're showing here, for those of you who can't see it, it's really looking at leverage. Part of it's looking at leverage for direct lenders versus bank-led transactions. And what we see here is that in the most recent quarter, leverage increased for direct lending deals on average, but it continued to move lower for bank-led transactions. So I guess arguably no surprise there. And just to put some numbers on it, for the direct lender deals, that leverage averaged about 4.7 times in the most recent quarter. On the other hand, the leverage for bank-led deals was around 3.56%, and that was the fifth consecutive quarterly decline.
Very interesting, and it shows you again why the sponsors are trending towards direct lending. They can achieve a higher leverage multiple with greater certainty. It makes perfect sense.
Yeah, exactly. Again, another selling point, as you point out. Now, next, just to talk about pricing a little bit. As I mentioned a couple of times already, it's a really bifurcated market. With the terms are getting looser for good credits, and here what we're looking at here is our yields, and what we actually see is that direct lender-led sponsored middle market deals, the yield premium over the large corporate deals declined to just over 200 basis points in the second quarter. And so just to put some numbers on it, if we look at on the direct lending side, the average yield was pretty flat at about 12, close to 12.5%. I think it was 12.4%. As basically the lower spreads that were seen in the market were counterbalanced by the higher base rates. And obviously higher base rates, as Maria alluded to, I think earlier on, is whether it's direct lending or the syndicated market, that these higher base rates have driven overall yields higher in the last 15 months or so. Just want to move on now to the final chart here on the direct lending side, and this looks at average coverage ratios. Obviously, very pertinent these days, being very widely tracked. For both new loans and existing portfolios. And what we see here is that the interest coverage ratio slipped in the most recent quarter to about 2.2 times. And that's actually the lowest level since LPC started tracking the data. And again, same theme, higher base rates having an impact here.
I mean, it makes sense, 5% increase, a more than doubling of the yield should result in lower coverages. But when you look at it, it's a little scary.
Yeah, exactly. It is, and it's something I think we'll just have to keep watching in future as we progress. And also, just to add a little bit more context here, is not surprisingly, you see different variation based on borrower leverage or deal leverage. Where the higher levered borrowers, not surprisingly, have lower interest coverage. And just to cap it off with a few stats again, is that if we look at issuers that are levered less than 4 times, their interest coverage was 3 times in the second quarter. For companies levered 4 to 6 times, it was at about 1.97 times interest coverage. And for borrowers levered more than 6 times, the average interest coverage ratio was 1.49 times. So as Barry mentioned, this the benefit of getting the charts here and looking at them. You can actually see these trends a lot clearer.
Yep.
So that's it from the direct lending
Great.
side.
Thanks, CJ. Very detailed, very helpful. That's great. Well, Maria, let's bring it home with your and my favorite topic here, the asset-based market. And CJ, one more there. So, I mean, I'll tee it up for you, Maria. But if you didn't know better, you'd say it was an amazing time for asset-based lending. It's a good time,
Right?
But it's the volume numbers. Historically, we've been in a market that was kind of 80 to 100 billion in annual syndicated volume.
Yep.
We've had a couple of record years in a row, and you said, okay, that's over. But now we're on another record pace. But there's a footnote. So why don't you take us through that?
So to your point, over the last few years, we've seen sort of a steady increase in ABL issuance, and that's largely, although not exclusively, fueled by kind of COVID debt, and we would expect a little bit of a pre-pandemic normalization of issuance, but we saw volumes shoot up. They for the first half of the year, they're at almost $114 billion. That's 52% increase year over year. But and CJ, if you could please advance one. The refinancings fueled activity, and so that's not altogether surprising. It's in line with the broader leveraged loan market trends. But digging into the numbers a little bit more deeply for ABL, we find that once again, refinancings are largely driven by SOFR adoption. So what we did was, you can see our syndicated refinancing chart in the slides. What we did is we took those volumes and we drilled into them a little bit, and we found an estimated 60 billion of total refinancing volume we estimate to be related to SOFR adoption.
So another Maria, more than half of the volume that's showing up as syndicated volume is SOFR only amendments, just cleaning up their fallback language. And just to remind everybody, LIBOR terminated as of June 30th. It doesn't exist. Well, that's a footnote, but LIBOR went away. And so everybody needed to clean up their fallback language. And so you had more than half of the reported volume as SOFR only amendments, just doing that only and not affecting the underlying. How do you get to that number?
So we basically looked at issuance that was refinancing issuance with no incremental dollars raised and no maturity extension, and we didn't dig in too deeply into price adjustments, but we assumed no changes in pricing, and that came out to about 60 billion. Anything that has a maturity prior to 2008, we kind of examined to see
2028.
2028. We examined to see whether the refinancing took place without a tenor extension as well. So
So, but it's interesting to me that if it's 115 billion, and 60 of it is pure SOFR, and there's probably others that are there. That's still a pretty robust market. It just it's not what was reported, but compared to where we were pre-pandemic, it's still a pretty good volume of refinancing.
Yeah, it's a little bit ahead.
Yeah,
absolutely, it's a little bit ahead, but it's I think more in line with a market that was generally growing a little bit anyway. So
I'll take the next couple of charts here because these are coming from SFNet survey, but just to sort of lay it out, the utilization is something that we tracked heavily in the quarterly survey, and just what happened was in the early stages of the pandemic, utilization dropped to levels never seen before and was really reducing loans on the books. The facilities stay there, but the utilization rates were in the 30% and maybe even lower in some cases. And then they spiked back last year, in particular, because there was, as other markets began to falter, you had a lot of working capital because of inflation and supply chain issues. And you can see in the most recent quarters, and the most recent one here is Q1, we're always lagging a quarter. It's come down to what I would consider a historical norm in terms of utilization. It's a little higher for the non-banks that are reporting for the bank than for the banks, mostly because the banks have the deeper capital structures in there and other capital, but still a normalization and probably a stabilization at pre-pandemic levels at this point. And then the next one, CJ. This is a chart that banks are also focused on credit quality. This is the survey data again from SFNet, and it looks at both criticized and classified, and also non-accruing. And from a criticized and classified standpoint, the reporting information would say that while it has ticked up in recent quarters, it's still well below the peak. Levels that were seen in the past, and I would say this is a normalization or a return to normal as well, from an artificially low level because of all the fiscal stimulus. On the chart on the right, what you can see is the non-accruing loans, maybe the losses as a proxy, and while they have ticked up, they're at an extremely low level, and so I think you have to balance that when you look at credit and the asset-based market. You have certainly an increase in defaults and in stressed credits, but the losses remain extremely low, and that's the benefit and the main selling point of asset-based lending.
I think what we've found is that the leading industries in the ABL space are largely unchanged. Retail, wholesale, general manufacturing, they certainly continue to dominate. But what we've seen is that their proportions have come in a little bit. So there is a little bit of a shifting in terms of what industries are tapping the market and really what is being raised in terms of dollars. So this pie chart to the left highlights that. To the right, what we show is, again, for these same leading industries, we're just showing a spread dispersion, highlighting average pricing, and then the bands between the min and the max pricing. And we've seen that that's widened out a little bit. So I think those are the key takeaways from this slide. And then for the next slide, what we're looking at is pricing in the ABL space. We know anecdotally that pricing is up. Most deals are pricing in the north of certainly 200 basis points over term SOFR, probably in the range of 225. But there's our numbers, there's a little bit of a stickiness in terms of reflecting these shifts. So we expect them to kind of be more visual over time. But we do see a slight edge up in our pricing stats. And then more noteworthy is the chart on the right, which shows that, over the last few quarters, we have seen a larger proportion of deal flow from a deal count perspective, pricing north of LIBOR plus 250 or 275.
Yeah, it's interesting to parse through that. If you assume that the reason they're doing SOFR only amendments is because they don't want to touch the underlying spread because it's attractive. If you take all of those SOFR only amendments out, the average spread goes up a bit, which is what you'd expect. But it still seems to me sticky, and I have to think, Maria, and I don't know if you have a thought on this, but it really reflects, I think, the better quality issuers will come to market and are getting relatively attractive pricing. Those that would really have to reprice significantly or come in higher, if they can avoid coming to market, they're doing it. It explains maybe why the refinancing volume is the new money volume is low, and why volume overall is not growing.
Right. And I also think it reflects the fact that, and we'll see this in the next two slides, just the maturity wall has not moved as dramatically as we used to see it shift quarter to quarter. Because it's just, if you don't have to tap the market, you're not going to come to the market. So, or you'll do it just for SOFR adoption. So, and I think that this next slide just kind of echoes this, or these points. We see that ABL pricing against double B and single B comparable pricing, both in terms of institutional lending and pro rata lending. And it basically lays out once again that even with pricing edging up in across the broadly syndicated loan market, the ABL construct is still kind of the best option for issuers that have high quality assets and require liquidity. So
couldn't say it any better myself, Maria. Thank you.
There you go. And then the last slide is what we just touched on. It looks at outstandings and the maturity wall. So again, the chart on the left shows outstanding ABL loan commitments have, steadily, but I would say reasonably increased over the last few years. We certainly have not seen any slowdown in that regard. Outstanding commitments are now at a record 355 billion. The chart on the right is shows maturing volume, so the maturity wall. And what we find is that over the last 18 months, there has been about 246 billion of ABL commitments that have been refinanced. But at the same time, if we look at the chart, and I do think it's helpful for folks to really reference it and look at it, we see that to the point that you made earlier, Barry, we should expect in 2024, 2025, borrowers returning to the market to refinance because there is a large concentration of maturing debt coming due in 2026.
Yeah, I mean, anytime we get into a discussion about maturity wall, and it certainly was a big discussion after the 08-09 financial crisis, the better quality issuers, even if it costs some more, will try to get out beyond that wall by refinancing early. And those that are facing very unattractive refinancing will wait and hope that markets improve. But you really should start to see a wave of refinancing starting, I think, next year, and certainly heavily in 25 based on these numbers. Yeah. Well, this is great. And I want to thank both of you again for participating. I want to thank, in particular, at Secured Finance Network for hosting this episode. And I have to thank our sponsor, Hilco Global, for making it all possible. And I look forward to our next discussion whenever that happens. Thanks, guys.
Thank you so much.
Thanks, Barry.